There is some impact on your money when the stock market falls, no matter how diligently you plan. Many experts provide lists of precautions to take in case the stock market falls. But what happens when it does? Experts who have provided fail-safe answers are few and far between. In these circumstances, the pressure is fairly severe since not everyone is patient or financially secure till the stock prices go back up. Start by taking a deep breath, relaxing your body, and following the instructions in this video. Before we begin, don't forget to hit the like button, subscribe to our channel, and ring the bell symbol for more wonderful videos. Nothing. If you are a long-term investor. If you're a long-term investor, the best course of action is to do nothing at all. The stock market condition is less of a concern for long-term investors because it doesn't significantly affect them. The volatility of the stock market is the easy explanation for this. If the market is down today, it will be back up in a few days. As a long-term investor, it is advisable to remain passive because the wave will continue to flow with both upward and downward thresholds. Additionally, because the prices are approaching the threshold of decline, there is a window of opportunity to purchase more stocks for long-term investment. By merely spending a small amount at these periods, you may reserve more profit for the future. Invest only as much as you can after saving enough for the next 5 years. For those who are involved in short-term marketing, a stock market drop is never good news and is always upsetting. The most frequent explanation for this is that the money engaged in the market is really the money obtained via loan applications or the filing of complete assets. Without having adequate money saved up for the next 5 years, we do not advise any marketer to invest in the stock market. A stock marketer needs to be informed and aware of the volatility of the stock market. Stock market investment is not a wise idea, and it will ultimately result in significant losses. Make sure you have enough gasoline left if the money is taken away if you are investing in stocks today. I myself utilize a method that involves investing a specific amount of money in the stock market, which has no significance to me. Therefore, I will continue to operate with the normal stream of income even if the money disappears tomorrow. Diversifying income portfolio. Like a shrewd marketer, you should also develop resources outside the stock market that can guarantee ongoing revenue even in the event of a stock market catastrophe. A diversified income portfolio might lessen the effects of a stock market downturn. When the stock market is generating gains for you, we advise you to continue to accumulate assets. Your financial stability is guaranteed even after the stock market fall if you have a steady stream of income. Create an income strategy that is more robust and diverse, but does not include the stock market. Starting today, we advise you to diversify your investments in the same way Warren Buffett advised against putting all of your eggs in one basket. Be prepared to purchase the dip. Dips in the market might sometimes be a good time to purchase. Imagine doing it as buying discounted stocks during a market meltdown. It's important to be prepared for the worst and ready to spend some money in order to buy investments whose values are falling. How can you assess if you might be prepared to purchase the dip? You already have money set up for retirement, a reserve for emergencies, and cash on hand for daily necessities. You've saved some money so you'll be prepared for a flash sale if a catastrophe occurs, and you keep a running list of certain equities you'd like to acquire. If you choose to purchase the drop, you most likely won't get the stock at its bottom. But that's okay. The idea is to take advantage of opportunities when making investments that you believe have strong long-term potential. If you remain still when the chance arises, don't be shocked. Dollar cost averaging your way into the investment is one method to get over your fear of bad timing. Dollar cost averaging smooths out your buying price over time and invest your money while other investors are sitting on the sidelines or running for the door. Buy more stocks if you can. When the market drops, there is a fantastic opportunity to acquire additional stocks. The time is now to acquire more stocks if you have enough money saved and other assets that bring in income. The rationale is straightforward. When the stock market crashes, all prices are lower, making it the ideal time to buy low and sell high. Buy low and sell high is a stock market maxim that is well known to all investors. In the event of a stock market meltdown, you can purchase more short and long-term equities that will provide gains when the market recovers. But are you going to buy the stocks blindly because they are a low price? I bet that would be a mistake. We get it. The stock market crash is luring investors who want to buy more. But that does not mean you can buy stock blindly. Here, as a stock marketer, one needs to have patience and solid research of the company. This research includes important data, such as the estimation of how long it will take the companies to raise the stock prices by giving a great performance if the expense ratio and other statistical data point the investors in the right direction, and if the stock market crash has, directly and indirectly, impacted the company in a way that can disturb the performance of the companies. One can invest after the stock market fall and increase their profit after taking into account everything said above, but before the impact of the stock market fall is diminished and prices start to climb again. All of this laborious research needs to be completed in the shortest amount of time possible. Focus on the long term. It can be frustrating to see the value of your portfolio drop during a stock market downturn without taking any action. In a year when you may have experienced illness, loss, or job loss due to the COVID-19 pandemic, it may be very difficult to watch your portfolio decline. Although it's common to feel negative following a fall, the wisest course of action is frequently to do nothing if you're investing for the long run. The fact that you lock in your losses when you sell investments during a downturn must always be kept in mind. Consider the market catastrophe that occurred in February 2020 because of COVID. Let's imagine that you had $1,000 invested in an exchange-traded fund that followed the S&P 500 during the spring 2020 meltdown. A fund of this type would have seen a loss of value of more than 30%. If you had sold, you would have locked in that 30% loss. But if you had hung on to it, you would have made up for your losses by August and seen it continue to increase ever since. If you want to get back into the market when conditions are better, you'll almost definitely have to pay more for the privilege and give up some, if not all, of the gains from the bounce. We are aware that stock market crashes are depressing, but all it takes is patience and good decision-making. After the crash, if you can, buy more stocks and consider making long-term stock investments. The stock market is erratic. Even if it is at a record low right now, it will soon recover again. That's it for today, guys. What did you think of the video? Please share with us in the comments section below. Also, don't forget to hit the like button, subscribe to our channel, and ring the bell icon for more incredible videos.